Perfecto. Okay, good afternoon, everyone. I'm Patricia Lizarraga, member of the Sustainability Committee of CFA Society, and it's a pleasure to welcome you and to moderate today's webinar together with Federated Hermes and James Cook. Over the next 40 minutes, we will delve into one of the most relevant, impactful areas within responsible investment, that is active management. James will share with us today a particularly significant case with the government of South Korea, including several white letters that have driven meaningful improvements in corporate governance and as well minority shareholder protections, with the ultimate goal of reducing the well-known Korea discount. As you know, one of the main objectives of the Sustainability Committee is to promote and strengthen the certificate in sustainable investing and to promote knowledge in the area of sustainability, such as this webinar, as we are completely convinced of the need of prioritizing sustainability, ethical practice, and social responsibility now and as well in the future. So it's an honor to have Federated Hermes, global leader in active and responsible investments management, and James with us today. Please note that this webinar is going to be recorded. And before we begin, allow me to introduce our speaker, James Hook. And James joined Federated Hermes in November 2011 and currently serves as investment director. In this role, he oversees the investment specialist team supporting all equity and fixed income products. And he's also investment director for emerging market strategies. Previously, James worked in Fidelity Worldwide Investments as a product director. And for emerging markets as well, equities 2005 and 2011, and before that at Trinidad Investments in investment communications. He holds a degree in economics from Royal Holloway, University of London, and the investment management certificate. So we will have time for questions at the end of the session, but please feel free to send to me the questions throughout the webinar, and we will try to address as many as possible. Please, James, the floor is yours now.
Gracias, Patricia. Buenas noches. It's my pleasure to speak with you this evening and talk about engagement in a market that's very critical to us as investors in Korea. And as Patricia suggested with her introductory comments, one that is very relevant today we are seeing very positive change in terms of corporate governance. It's something we as investors have been passionate about in our now 16 years of investing in the region. I'm going to ask my colleague Diego to turn slides, so there will be a little interruption. Diego, just to put into context who we are at Federated Hermes and the Asia ex-Japan strategy that I represent. We are a large $870 billion asset manager with our headquarters in Pittsburgh and offices including my own and the teams in London and throughout the world. On the public market equity side, then our Asia ex-Japan strategy is certainly a flagship fund. The other aspect of the Federated Hermes business that we are well known for is our more than 3 decades in responsible investment. There's a very large number here on the slide. $2.2 trillion are the assets under stewardship. And if we go to the next slide, Diego, this is overseen by our proprietary stewardship team known as EOS, or Equity Ownership Services, and they advise the asset owners and across now 14 different countries around the world. These are institutions, asset managers, pension funds, sovereign wealth funds, with a total assets under advice of $2.2 trillion. That is a very powerful voice with which to access the C-suite of management. We have 35 engagement professionals from all walks of life, professions and academia, who engage on a myriad of objectives with the underlying companies that they represent. In fact, 2024, we engaged with nearly 1,000 companies on behalf of the institutions that we represent. As an investment team, that is gives us great insight into the companies we're looking to invest in, and in terms of understanding the trajectory and progress that those companies have made. If we could just go to the next slide, Diego. Now we're a very different way of investing in the Asia ex-Japan region, and that largely goes to our contrarian bottom-up investment focus. So we're trying to identify the most attractive price relative to value opportunities. We don't mind investing in companies that are out of favor where we assess that to be for a temporary reason. And often we find the most attractive opportunities in the most hated markets and the most unloved sectors. I'm going to talk about where we've been investing and the market that we're focused on. But first, just to say that we absolutely prioritize and focus on effective engagement. We have 60 companies in our strategy today. We look to leverage the work that our colleagues in EOS undertake, as well as our own resource within our team. We have a lady, Seyon Ko, who is a dedicated ESG specialist within our team, who leads the engagement work with the underlying companies that we hold within our business. Being contrarian, doesn't mean that we don't mind investing in companies that perhaps are bad operators. We've certainly focused on where we believe our engagement can be most effective, and historically, we've tended to not prize the best ESG rated companies in our markets because often they are expensive and there's very limited scope for improvement from engagement that we have with those companies. If we go to the next slide. Now, thinking about our focus on where we find the most attractive price to value opportunities, this very simple dollar return chart over the last decade shows you potentially where we've been finding a lot of opportunities. And you can see here there's enormous divergence in market returns within the region. We look here at the four largest: Taiwan, the orange line, India, the grey line, Korea, the green line, China, the blue line. And immediately you can see there's been enormous divergence in returns across the Asia region. Taiwan, the orange line, has been by far the best performing market over the last decade, has in fact outperformed the S&P 500 that we show for comparative purposes, the dark blue line. And of course, technology has been a very important determinant and driver of those two markets. India is a market, the grey line, that has also done very well. What hasn't performed well until this year, or sorry, we're now in 2026, but until last year, Korea, the green line, had basically gone nowhere, and China had given investors very meager returns. If we go to the next slide. Now, those two markets that have been the worst performing over the last decade, Korea and China, have also been the cheapest from a valuation perspective. And our focus as bottom-up contrarian investors is certainly, or we're naturally attracted to markets for whatever reason that have been discounting different risks. Now, China has faced many risks over the last several years. For a lot of investors, it has been uninvestable. I think last year was the first year that I haven't heard investors refer to China as being uninvestable. And you can see that both Korea and China on this valuation chart have been the two cheapest of the four major markets over the last decade. If we go to the next slide, Diego, thank you. Now, Korea is a market that we have very consistently found a lot of attractively valued companies. It has by far been the most consistent overweight market in our now 16 years history of being in business. And to put some numbers to just how cheap the Korean market is, looking across the region, you can see from the bar chart that nearly 70% of Korean companies trade below their book value, and some 30% trade below 10 times PE. You compare that at the other end of the table to India, and less than 4% of Indian companies trade below book value, and about 8% trade at a single or below 10% P multiple. Now, the Korea discount, as it is known, has largely reflected not only the cyclicality of the Korean market, it is a very export orientated market, but primarily it has been a reflection of the poor capital allocation, poor corporate governance, and opaque structures relating to the ownership structure of Korean companies. It is a market that we've been attracted to because of the compelling valuations, but it is a market that we have found very frustrating in terms of the capital discipline and the governance of the boards of the Korean companies that we have invested in. Now, many of you will be aware of Japan's progress in tackling the Japan discount in a very successful program launched in 2023 by the Tokyo Stock Exchange to drive a value up program, which they have been very successful in doing. You can see today that around 35% of Japan companies are trading below book value, and around circa 10% below 10 times PE. Japan's ownership structure is very different to Korea's. Japan is controlled today by, or 90% of Japanese companies are controlled by founding family, by shareholders. In Korea, 90% of Korea's market capitalization are controlled by founding families known as chaebol, some 500 companies where the interests of those families have been at the center of the strategy of the boards that have overseen those businesses. Korean companies are, and I'm broadly brushstroke speaking here, have been profitable, but the shareholder returns have been woeful. To give you an idea, the payouts in Korea has been about 10% compared to the global average of about 30%. We have been investing in the Korean market for more than 20 years today, and we know only too well just how we have been mistreated along with other market participants as minority shareholders. Diego, if we could just move to the next slide. Thank you. Now, our colleagues in the stewardship team have led a lot of, and indeed have a long history of engagement in Korea. We have dedicated Asian and local language speaking engagers that address a myriad of topics and voting on resolutions that we bring to the boards of companies. And that has certainly been the case within the Korean market. Ourselves, we have very much focused on the governance aspect in Korea. That is where we have felt we would have the greatest impact. And we often, in fact, we're just penning our annual letter to investors today. But the letter that we are most proud of in our 16-year history was the one you see the front cover here. South Korea is enough. This was published at the end of 2023. In fact, it took several years to clear our own legal and compliance teams. So we were delighted when it was eventually published. But this really set out to educate other market participants as to how minority shareholders were being mistreated in the Korean market. When we did publish the letter, it very quickly gained traction within Korea, and particularly a growing army of retail investors who, of course, have enormous political power. Something we've seen in Asia over certainly through COVID and post-COVID is an accelerating participation by retail investors in domestic markets. You've seen this in India, you've seen it in China last year, and in Korea pre-COVID, roughly 10% of trading volumes were retail investors. Today, that is over 40%. That is 14 million voting public asking the same question that we have asked for many decades as to why the payout ratio in Korea has been so ridiculously low. Now, in the immediate aftermath of publishing this letter, the then President Yoon announced that Korea would have its own value up program. So this is back in the first quarter of 2024. We were enormously frustrated because President Yoon chose to go down a very similar, almost mirror framework that Tokyo so successfully adopted in indexing and a voluntary program for Korean companies to publish strategies to realize the value in this business. We followed up our 2024 letter with another called The Unpersuadables, which really set out 6 key recommendations for the Korean regulator to go much further than President Yoon did in the initial value up program of his government. The first recommendation was to end compelled share swaps by requiring separate minority shareholder approvals for swaps or dilutionary share issues when issued in exchange for shares. The second was to introduce a mandatory tag-along rule for any takeovers. The third was to require minority shareholder separate approval for related party transactions. And then a requirement for shares that have been bought back, including those that had been accumulated and held in treasury, to be cancelled, excluding those that were held for regulatory reasons, so banks and insurers. We also called for a codification into law of a director's fiduciary duty to the company and to the shareholders. This really was the most critical of our recommendations in addressing rather than simply a duty or a loyalty to the company, which is an ambiguous concept and open to varying interpretations, to have a legal duty or fiduciary duty to both the founding families and minority shareholders. And finally, a requirement for an annual statement of all directors to address balance sheet capital management. That included a series of recommendations in terms of those companies trading below book value. Certainly, a plan to raise stock prices to at least book value, but I'll leave that detail for another day. Now, I mentioned the retail participation in the trading market because I certainly feel we can take some credit. We can be so bold that this letter, really galvanized and certainly on both sides of the political divide, woke respective left and socialist and right-leaning governments to start to address the Korean discount. But I think that retail participation factor and the fact that such a large part of the voting public were so attuned to this challenge, we saw a big shift. For decades, we have been engaging with companies about the issues and made very little progress. Now, I said our frustration in 2024 was the then President Yoon went down a voluntary program. He was impeached at the beginning of last year, and that triggered an election. And fascinating to see that the Democrat Party, then in opposition, actually ran on a ticket to get Korea's Kospi index to 5,000. Now, to give an idea, at the beginning of 2025, the Kospi index was trading as low as around 2,350. Very rare to see a government actually or a political party run on a mandate to get the stock market to a certain level. And they promised to get the Kospi index to 5,000 within their first term. The stock market is a very easy or relatively easy means to creating wealth. And in the Korean market, property historically has been the primary means for wealth creation for Koreans. Today, that market has very tight supply and affordability is beyond a lot of Korean citizens. So the Democrat Party, attuned to the change towards governance, as well as recognizing the stock market as a quick or easier means to wealth creation, ran on this ticket to get the Kospi index. Now, why is this time different? Well, they won the election with a landslide mandate, a 75-seat majority in the National Assembly. No government in Korea since the early 1980s had been afforded such a strong mandate. And that enabled them in quick order to bring in some of the recommendations that we made. And in July, they brought into law a new commercial act that indeed did change the law and bring in a legal fiduciary duty to the boards of Korean companies. And that was brought into effect immediately. Diego, if we can just go to the next slide. And this commercial act, we believe, is a milestone moment in Korea and for investors in the Korea market. You can see the market performance of the main markets in Asia again. and the S&P 500 for last year. And Korea, the Kospi index, the green index, was the best market, and in fact led all markets in 2025. Now, in part, that was related to AI demand for memory. Korea is home to two memory majors in Samsung and SK Hynix. So that certainly was an important part of the move higher. But this change in government and the change in the Commercial Act, this new fiduciary duty that was enacted in July, was the other significant catalyst for what has been quite a phenomenal re-rating in the Korean market. In October, the Kospi index went through 4,000, and we've seen the Korean market start very high, had a very strong start to the year in 2025. Now, we believe that there is more to come in terms of the recommendations that we have made, and further progress that we anticipated and in our recommendations. Today, we have learned that one of those, the fourth recommendation to cancel treasury stock, is now in line to go through the National Assembly, which the government, the Democrat Party, control. This has been the means with which the families have been able to maintain controls within the family group. So this is going to be absolutely critical. The government has also announced tax changes that encourage higher dividend payout ratios, and also are starting to look at and tabling, debating, addressing the high inheritance tax rate. This has been one of the key reasons for the families to keep and artificially suppress their share high prices historically. The inheritance tax in Korea is over 60%. So losing a member of the family is incredibly punitive. Lose two members and Korean companies are nearly wiped out. So historically, Korean companies and their boards have sought and through different means to keep their share prices depressed. They've also focused on keeping the dividend payout low because they don't want to attract yield-hunting investors, which will drive the share price higher. So inheritance tax remains very high today. The government is now tabling and looking to lawmakers to address that in the future. The requirement for cancelling treasury stock, we anticipate, is going to be passed into law soon. That is going to reduce the number of companies controlled by families, and hence reduce that incentive to keep the stock prices low. Even in the context of a high inheritance tax, because directors of companies no longer controlled by families won't be beholden to the selfish family interests of the past. So, it is very rare to be able to lay claim that the engagement work that we do as investors with the underlying companies has had a real positive impact. And we do feel very proud that the letter that we published and the multi-decade campaign that was led by my colleague Jonathan Pines, who's the lead portfolio manager on Asia ex-Japan strategy, is having such effect in the improvement in corporate governance within the Korea market. There is more to come, and that is what we anticipate in a further re-rating to come as that discount in the Korea market gets narrowed from here. We are an award-winning Asia ex Japan strategy. We're amongst our peer group one of the top performing. But the award that singularly we're most proud of in our 16-year history is actually one that came last year, at the beginning of last year, from the Korean Corporate Governance Society for an Innovation Award. And indeed, we are the first foreign nationals, my colleague Jonathan Pines getting the award, the first foreign national to receive such an award for the work that we have done to address the poor corporate governance. I'm very conscious that this is the early part of your evening, and I'm sure everyone has had a very long day. But I'm going to stop there and just thank you for taking the time to stop by and listen to what I hope has shed some light on perhaps a market that's often overlooked in Asia, and one where we're very excited today that real corporate governance reform is having such a positive effect.
Thank you so much, James. I mean, you have indeed. So it was very, very interesting. Thank you so much. And you should be proud of the impact. That's we can really see it. So thank you. We have, I mean, I know we don't have too much time, but just two questions that we would like to make. One is regarding all these sustainability reforms that we have been talking about, and the main one that you mentioned in 2025. We know that they represent a major step forward the Korean market. In your view, what elements do you think are most critical for ensuring that the Korea discount closes in a structural long-term way? And although you have been as well answering that, do you think that inherited tax reform truly is the key catalyst for that?
Well, the recommendation that was key was the fiduciary duty law, the change in the law to give the boards of Korean companies the legal duty to treat all shareholders equally was absolutely critical, because it was, clear to see in 2024, after we published our initial letter, that Korean companies were going to continue to do what they'd always done, because there was no legal requirement for them to do anything different. If you can get away with something,
Yeah.
You're going to carry on doing it. We were cautious, positive, but starting to grow a little bit cautious following the milestone of the Commercial Act in July, because the next critical recommendation in cancelling treasury or shares held in treasury, another means the families have sought to control through limited holding the companies. It looked like that was being pushed down the legislative program. It had been tabled for the third quarter, and then in December there were further delays. So the news today that they are, progressing on that, and in fact the government said that the delay was purely because there were more important things. And let's not forget, trade uncertainty has fallen across all markets globally,
Yeah.
not least Korea, where exports is absolutely critical to the Korean market. So I think, now President Lee Jae-myung had two things to focus on: one, to get a decent trade deal with Trump, and two,
Yeah.
to address the Korean discount. So we're very excited that the second, perhaps most important recommendation looks like we've now got that back on the political agenda, at the top of the agenda, in addressing cancelling treasury share. In terms of the dividend inheritance tax, well, we've had progress where they've lowered dividend yield tax from 60% to 45% to our bull case, which was 25 to 30%. And our hope now is that they will look to lower inheritance tax. And I think it's important just to say these taxes are not just going to benefit Korean companies, they will benefit all Korean
Oh, yeah.
people, right? So there's the political
Hmm.
will to address these things. As it relates to the Korean discount and the value in the Korean market, then certainly, uh, removing one of the barriers and one of the reasons Korean companies have sought to suppress their share prices, uh, it just means Korean companies will do the right thing going forward, where historically they've been very conservative in looking after and prioritizing the family interests.
Yeah. Thank you. And just the last one. Um, I mean, you have been mentioning that many Korean companies still trade below book value, and this creates both opportunities but as well potential traps. So the question here is, what specific signals do you look for to distinguish genuine opportunities from companies that are cheap for structural reasons?
Yeah, and actually, that's a great question, Patricia. Thank you. And I think important, reforms that we're discussing today certainly reduce uncertainty for us as minority shareholders in terms of how we're going to get treated and the capital return policies, and that can lower, as we hope, the equity risk premia and lead to multiple expansion, even if the cash flows of the businesses remain unchanged. But of course, the core drivers of companies are going to be cash flows and sales and how they're managed, their capex efficiency, and of course, those things are going to be influenced by structural factors like AI. I managed to do a 35-minute discussion without mentioning AI. Well, no, I did mention AI as it related to Samsung and SK, but also demand, obviously, demand for
Yeah.
those businesses. So whilst we uh, have a preference for companies that are attractively priced relative to their quality, we're not just investing in things because they're cheap. We need to see, and indeed we look for companies having a long history of and demonstrable history of generating decent cash flow, the prospect to continue to do that, with a policy to return excess capital to us as shareholders. I mean, we forget the primary reason for investing, and holding shares is the shareholder returns that we get.
Yeah.
And that's why in Korea we've been so focused on addressing that aspect. In the main, the companies we've selected in Korea have been profitable and have delivered decent results. We've been able to make money despite the mistreatment. And now we hope that this governance reform will do the other part in terms of, as you've seen, Korea was trading. I didn't say that at the beginning. Korea was trading below book value in this time last year, was on 0.8 times book and something like 7.5 times PE. Today it has re-rated substantially. As I mentioned, certainly AI memory demand has played a part for the major, Samsung and SK are about 35% of the Kospi index. So certainly their move higher last year has had a major positive move. But you've seen that multiple expansion, and today the Kospi is trading on about 2 times book. So I'm sorry, 1.6 times book. It has moved substantially, and that's certainly around this reform, and now the positive momentum as the government continues look to do more.
No, thank you so much. Thank you. I mean, we are on time. Thank you very much, Hermes Federated, but as well, thank you very much, James. It was super interesting, the topic. I think we could talk long way, but as well about IA.
Maybe you can invite us back in again in maybe 18 months, and we can come back and
For
revisit
sure.
and see where we
Let's
are.
see if it has even go up.
Thank you, Patricia,
No,
and thank
thank
you
you so much.
everyone for your time.
We look to we look forward to seeing you again. Thank you so much.
Muchas gracias.
Gracias.